All right, welcome to this explainer. If you've been trading for a while, you probably know the exact feeling of waking up, grabbing your phone with one eye open, staring at a total sea of red on your stock charts, and just trying to guess whether the market is going to miraculously recover today or tank even further. It is an emotionally exhausting roller coaster, isn't it? Well, most retail traders really believe they need some sort of crystal ball to predict market direction to actually make consistent profits. But here is the open secret. Professional, institutional options traders approach the market in a completely different way. So today, we're going to challenge that amateur mindset of constantly guessing. We're going to fundamentally change how you view your portfolio, moving you away from rolling the dice and toward engineered consistency. Seriously, what if you could drastically reduce your exposure to market direction and still create incredibly lucrative opportunities to generate income? Well, that is exactly what delta neutral trading is designed to do. It's honestly one of the most powerful, heavily guarded concepts that professional market makers use to manage their risk and improve their consistency. Getting insulated from market swings is literally the holy grail for institutional traders because it lets them generate revenue without needing to be right about the future of the economy. Instead of relying on directional predictions that, let's face it, are often no better than a coin flip, they build these strategic architectures that actually insulate their capital from the market's wild, unpredictable swings. So, here is our roadmap for today. We're going to cover the directional trading problem, understanding option delta, achieving delta neutrality, how professionals generate profit, popular strategies and risks, and finally, key takeaways for traders. Now, don't worry if the options math sounds a little intimidating right now. I promise you, we are going to break down these complex institutional concepts logically, step by step, until this framework becomes absolute second nature to you. Okay, let's jump in with Section 1, the directional trading problem. You know, the traditional approach to the stock market is painfully binary. You buy a stock hoping it goes up, or you short a stock hoping it goes down. Ultimately, you are predicting direction. But as we all know from painful experience, the market is wildly unpredictable. Think of the market like a giant casino. Retail traders are often the ones sitting right at the slot machines, pulling the lever, hoping for a lucky directional outcome. Professional traders, on the other hand, they act as the house. The house doesn't gamble. The house manages probabilities. By reducing their exposure to random price movement, professionals transition away from being gamblers placing directional bets, and they step into the role of risk managers, who operate based on structure, probability, and a real mathematical edge. Moving right along to Section 2, understanding option delta. Before we can completely neutralize our risk and stop caring about market direction, we actually have to define exactly what it is we are trying to neutralize in the first place. And that brings us to the most absolutely crucial Greek letter in options trading, delta. Delta is essentially your directional exposure metric. It acts as a direct mathematical link between the underlying stock's price and your option contract's value. Think of delta as the speedometer of your option. It tells you exactly how fast your option's price is moving relative to the stock. When you look at an option chain, delta is the number that tells you, hey, if this stock moves by exactly $1, here is exactly how much my option's premium is expected to change. It really is the heartbeat of your directional risk. Let's look at how the underlying math works in practice, because it's pretty fascinating. A positive delta means you're fundamentally bullish. For example, a call option with a delta of positive 0.60 is expected to gain roughly 60 cents if the stock rises by exactly $1. But on the flip side, put options carry a negative delta, meaning they are inherently bearish. So a put option with a delta of negative 0.40 actually gains value when the underlying stock falls. It's a simple relationship at the end of the day. Positive means you want the asset to go up, negative means you desperately want it to go down. All right, Section 3, achieving delta neutrality. 0. This is the magic number right here. A delta neutral position is one where your positive deltas and your negative deltas perfectly cancel each other out, leaving you with a net delta of precisely 0. Let's look at a really simple example to lock this in. Suppose a stock is currently trading at $100 and you buy one call option with a delta of positive 0.60. Now, since one standard option contract controls exactly 100 shares of stock, your total delta exposure is actually positive 60. To completely neutralize this, you could go out and short 60 shares of the underlying stock. Shorting stock gives you a strict negative delta. So your positive 60 from the long call, combined with your negative 60 from the short stock, equals exactly 0. Boom! You are officially neutral. By hitting this 0 mark, you are basically building a fortress around your trade. You're insulating yourself from all those tiny, unpredictable market ripples. Imagine a perfectly balanced vintage weighing scale. If the stock price moves slightly higher, your call option gains value, sure, but your short stock loses value by roughly the exact same mathematical amount. The daily gains and losses effectively just offset each other. You have taken the stock's short-term random directional movement completely out of the equation. Which naturally leads us to Section 4, how professionals generate profit. This is the absolute million-dollar question, right? If we aren't making any money from the stock moving up or down, we need to uncover where the profit actually comes from. Well, professional market makers focus on 3 hidden profit drivers instead. They generate income by collecting time decay, capitalizing on changes in implied volatility, and actively adjusting their trades as the market breathes. Let's pause on volatility for a second. This is often measured by another Greek called vega. When markets panic, implied volatility drastically inflates option prices. Professionals step in to sell these artificially inflated premiums, generating massive income by remaining delta neutral and just simply waiting for the market to calm down so that volatility crushes back to normal levels. And then there is the most consistent driver of all, theta. For a traditional directional options buyer, theta is your absolute worst enemy. Think of theta like a melting ice cube resting in the hot summer sun. For an option buyer, that ice cube is your asset, and it is shrinking by the minute, through the weekend and over holidays. But many neutral strategies are specifically engineered to turn theta into your biggest structural advantage. By selling options as part of a delta-neutral structure, professional traders are the ones holding the cup beneath the melting ice cube, collecting that daily decay. The mere passage of time itself becomes a relentless profit engine, completely regardless of whether the stock goes up, down, or sideways. But listen, we know the stock market is a living, breathing entity. It doesn't stand still, and neither can you. As the underlying stock price naturally moves up or down throughout the week, the delta of your options will dynamically expand and contract. Your perfectly balanced scale starts to tilt. Professional traders don't just set their positions on a Monday and then walk away to play golf for the rest of the week. No, they actively utilize delta hedging, which is buying or selling tiny fractions of shares or options to continuously rebalance those scales and firmly maintain that zero or near zero exposure. All right, let's get into Section 5, popular strategies and risks. Now let's ground all this heavy theory into reality. You don't have to just combine raw stock and options like our earlier example. The options market offers several sophisticated multi-leg strategies that are constructed specifically to start close to delta neutral. I'm talking about iron condors, short straddles, short strangles, calendar spreads, butterfly spreads, and ratio spreads. Let's make sense of these really quick. If you expect a stock to go absolutely nowhere and just trade in a tight, boring range for a month, an iron condor might be your weapon of choice. It builds a wide profit tent to collect that theta. But what if a company is about to announce blockbuster earnings and you expect a massive price move, but you just don't know the direction? Well, that is where a straddle or strangle comes into play, positioning you to capture that rapid surge in volatility. Choosing the right architecture depends entirely on your specific market outlook and the current implied volatility environment. But here is the ultimate reality check that takes down a lot of aspiring pros. We have to talk about gamma. Gamma measures exactly how fast your delta changes. If delta is your car's speed, gamma is your accelerator pedal. If the market suddenly spikes or crashes, gamma hits the gas hard, ensuring your delta doesn't stay neutral for long. Neutral positions can violently become highly directional in a fraction of a second if a massive unforeseen price move occurs. Gamma is that ever-present risk that your perfectly balanced scale gets tipped over entirely, which can force massive drawdowns if you aren't prepared for it. I want to make this exceptionally clear, and you should internalize this before you place a single trade. Delta neutral does not mean risk-free. No way, far from it. An unexpected, violent expansion in market volatility can dramatically inflate option prices and cause severe, instantaneous losses, even if the underlying stock price hasn't actually moved all that much. This is exactly why disciplined delta hedging, continuous portfolio monitoring, and strict capital allocation are absolutely mandatory. You have to actively manage changing market conditions. You can never just close your eyes and hope for the best. And that brings us to Section 6, key takeaways for traders. Let's wrap up this explainer by summarizing the core principles that will elevate your trading mindset. Here are your 5 foundational pillars to take away today. Number 1, delta measures your directional exposure. It's the speedometer of your trade. Number 2, achieving delta neutrality significantly reduces your portfolio sensitivity to those small, unpredictable daily price movements. Number 3, time decay, or theta, often becomes your primary relentless profit driver instead of waiting on price action. Number 4, implied volatility remains a critical, overarching source of risk that must be understood and managed. And finally, number 5, professional traders do not rely on luck. They continuously adjust their positions as market conditions naturally evolve. Understanding delta neutral trading is truly one of the absolute biggest steps toward thinking and acting like a heavily capitalized institutional options trader. Once you truly master how delta, gamma, theta, and vega all interact together in real time, you stop being a victim to random market direction and you start actually engineering risk. So, my final question for you is, are you ready to stop guessing where the market is going and start profiting from deep structure, time decay, and mathematical probability? If you found this explainer valuable and you want to integrate these advanced concepts into a highly disciplined trading plan, make sure to subscribe for more professional institutional education. Until next time, stay completely focused, manage your risk, and trade smart.